Now here comes a man who developed one of those toys that are designed to put bankers out of business because they sell trust an algorithm, don't trust a person who'd invest your money. Erik Podzuweit, CEO and founder of Scalable AG. He's experienced in finance and the building of digital business models. He was co-CEO for the German business of West Wing Home and Living. Before, he has spent 7 years as executive director with Goldman Sachs in London and Frankfurt. The bad guys. We love our prejudices, don't we? There he was advising financial institutes in capital investments and taking care of electronic trading platform. What he now develops for you is how to make more money of some money trusting a computer rather than a person. Please welcome Erik Podzuweit.
Thank you. That was a sweet introduction. So, what I'll talk to you today is how technology can improve the way private investments are managed. And I'll start off by pointing out what is quite obvious to most of us, is that with the current way advice in personal investing works is broken. Yeah? And I've named 4 examples of this. Firstly, it's very, very expensive. Yeah? So private investing advice at a bank, usually with the costs that you see and the costs that are covered, that are behind the scenes, usually cost you 1.5%, 2%, sometimes even 2 or 3 or more % a year, which is very bad for your long-term performance because the euro or the dollar that you pay away in fees now is not only missing in 30 years' time, but it also doesn't have the chance to compound over all those years in the future. So it's actually very, very, very costly. So cost cutting has to be one of the primary goals of personal investing, and banks just can't deliver that. Why? Part of it might be the classic stereotypes of the greedy banker, but mostly it's just a very, very costly infrastructure and the way they handle business. If you are a personal banking consultant, you can just cover 50, 60, maybe 70 clients a year. And if those clients are not millionaires, you have to get hundreds or even thousands of dollars out of them to even cover your overhead. Secondly, it's too manual, like I described. Thirdly, it's too misguided. So it's not like the banks don't possess these tools. They're simply not being made available to their client base because banks have an incentive to sell high margin products to keep operations running. And thirdly, very exclusive. So good and rule-based wealth management is just available to a very, very small group of customers. In Germany, for example, private wealth management, or Vermögensverwaltung like it's called, is just available to about, or just used by about 1% to 2% of the population. So what can be done to fight this? Technology. Because technology can remedy all of these. Technology can drive down the costs, it can take out cost factors that are not necessary for personal investing. It can get rid of the branches, can get rid of the investment manager, it can get rid of the salesperson talking to you, and it can automate a lot of tedious tasks that you otherwise would have to do yourself. And I'll focus on one specific example. There are numerous. I'll focus on one specific example, which is the management of risks. The management of risks. Why do I focus so much on this? Because apart from costs, risk is the most important factor in investing. And a big part of the classical industry focus a lot on returns. And we try to forecast returns. We try to forecast where the S&P or the DAX is at the end of the year. This, however, and numerous studies show that, is impossible. Or, put it another way, if I know where the DAX ends up at the end of the year, I don't need any risk management in the first place. But risks can be forecasted to a much higher degree than returns. And the reason is you have the so-called risk clustering or volatility clustering. And what you have here is a chart of daily returns of the German index DAX since 1980, but you could pretty much take any financial time series. And what you see is that times of high fluctuations, high deviations from the mean, and times of low deviations from the mean, they don't just happen randomly, they cluster. Yeah, you have periods of high risk and you have periods of lower risk. You can also see this if you look at other graphs. For example, on the left side, you see a chart showing the return of the DAX of the previous month and the return of the next month. And what you see is that it's pretty much noise. It's a cloud that's bundled in the middle. If you look at risks, and with risks we mean how far do you deviate from the expected mean, you see a certain pattern. Yeah? They don't cluster just like returns do. And the outcome of that is the following. If today or this month has a volatility or a risk that is higher than normal, higher than average, the possibility that the risk of tomorrow or next month is higher than normal is increased. So it gives you a chance to predict risks, not to predict the direction of the market, but just predict how volatile it will be, how risky it will be. The probability is not 1, it's not perfect, but it's better than a coin flip. And this characteristic, the so-called volatility cluster, can be used to make risk predictions. So why would you make risk predictions in the first place? Yeah, because we all learn at the business schools that risk is basically the currency to buy long-term performance. Yeah? If you want high returns, you have to invest into asset classes that are more risky. This is true in general, or on average, but it's not true in all market scenarios. What you can observe in financial markets is that if you choose risk classes or asset classes that are on average more risky than other asset classes, for example, equities are more risky than bonds, equities are more risky than cash, you get rewarded with a higher return in the long run. However, that is not true if you are in a very high risk environment. So if equities move from their normal risk, from their medium risk, so to speak, into a high risk environment, you actually get punished for taking risks. So what does this mean? You want to avoid these high risk, which is shown on the right, these high risk environments where the risk of one asset class substantially deviates from the average risk in that risk class. And if you find a method, for example, through econometrical simulations, you find a method to somehow avoid these high risk environments, you can enjoy better returns for the risk unit you take. And how is this done? This is done by so-called Garch Monte Carlo simulations. So what you see here is the path of your portfolio. Yeah, this is the historic past performance. And at each point in time, you can use technology combined with the latest empirical findings in the field of econometrics to simulate where this portfolio could move. You never know where it will be exactly, but you could simulate thousands or even 10,000s of different price paths, and what you'll get is a distribution function. And you can look at this distribution function and see, is it very wide? That might indicate a lot of insecurity in the future. Or is it quite narrow, and are the deviations from the mean quite bundled? That would tell you that the future is less uncertain than it usually is. And you can also look at the direction of this distribution function. And this can be used for the following. Here you see a bit of an abstract chart. If you define a certain risk limit for you, And then you see, like you see on the left side, then you see that this distribution function is in breach with your risk limit. You could go back to your portfolio and reallocate it in a way so that the prediction, the simulation of the risk satisfies your risk limit. And what comes out of all this? Here you see a simulation of a risk-targeted portfolio from 2000 till 2015. And the areas that you see in the darkish, bluish color, those are risky asset classes, like emerging market equities, European equities. And the light, the more brighter shades are less risky asset classes. Fixed income, bonds, corporate bonds, covered bonds, or even cash. And what you can see is that if you use risk as your main driver of portfolio allocation, you can see that this portfolio changes between states of being almost 100% allocated into risky asset classes, such as equity. It completely flips around into the lighter areas, into asset classes that are less risky, such as the fixed income asset classes. So you don't have static model portfolios. You actively have to switch between the asset classes. And the important thing is, you don't do this because of gut feeling. You don't do this because you open up a newspaper in the morning and make an interpretation of the news, because you can't manage a portfolio like this. Or you can't outperform the market doing this with gut feeling or manual investment management. However, if you use these statistical data that I showed you before to make an educated simulation of where the risk environment will move, you can actually generate better returns for the risk unit that you take. And here I've shown you one simulation that we've, for example, done last 2 weeks already. And what you see here is, what you see here in red are different asset classes. And on the vertical axis, you see the projected risk of these asset classes. The further to the right you are, the riskier they are. And on the left, you see their momentum in return. So the higher up you are, the higher they performed on an annualized basis. And what you see here is that we came out of an environment in the last weeks or even month where pretty much all equity classes had a very, 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 very high risk projection. So they were very, very far to the right and to the bottom right of this page. And this gives you a tool set how you can construct the efficient frontier that you see in the Turkish greenish part, how you can construct risk-efficient portfolios. So to close off, what's the benefit of all this? One is you can actively measure risks with statistical data, not just with vague marketing descriptions like moderate risk, dynamic risk, because at the end of the day, that doesn't tell you anything. What's a moderate risk? Can I lose half of my money, more or less? So you can actually put a number on the risks that you have in your portfolio. Secondly, as I described, you have a better chance at controlling risks, better than just guessing, which gives you more risk, more return per risk unit taken. And lastly, it's less stress, it's less emotional. That's almost a derivative of this whole risk management technology, because how the private investor behaves usually is the following. You invest into something, if it goes up, it's good. But as soon as you start losing money, you start losing 5%, you're a bit worried. You start losing 10%, you start growing more worried. And once you've lost 15%, you monitor your portfolio every day. And when you're down more than that, 20%, even more, you get irrational. Oh God, now I can lose half of my money or everything. And you pull out of the market. And pulling out has two very, very negative effects. One, you realize an investment loss. And secondly, you stay on the sidelines for too long. You stay on the sidelines, possibly even for years, to recover from the shock that you just had. And the market just rewards risk with return over the long run, not if you exit in terms of prices, like I've described. And this is where professional risk management can come in. And all these technologies that I've showed you, the Garch methods, the statistical methods behind that, nothing is really new. What is new is that it was not or is not available to the private investor. This is how the big banks, how the big sovereign wealth management funds manage their money, manage their portfolios. They're not doing stock picking. They're not making an interpretation of whether Volkswagen will move up or down. They're simply not doing this. They set a risk target and they try to follow it. But the private investor so far hasn't had access to this. And technology is changing that. Thank you very much.
That sounds a thrilling development. Questions? Things you'd like to know? Yes.
Hi.
Closer, like this.
Hi. Is this okay? Okay.
Right.
I'm just wondering, do you have an app for this, or how does this really work?
Yeah. So we have an app and a desktop application. Yeah. You can. We have both an app in the iOS shop and in the Android shop. And you can download it. And if you want to try it out, it's the whole onboarding process takes about 20 minutes. It's completely paperless and without wet signature.
Okay, thank you. And do you also advise people on what to get?
Yes, I mean, yeah, we do advise them. So if you're interested in the service, at the very beginning you have to go through an online questionnaire where we'll ask you about your financial knowledge, about your goals, about your risk tolerance, and then the algorithm will suggest an optimal risk category for you. And if you agree with that, you can continue with the onboarding process. So you're guided through that with an online questionnaire.
Okay, and can you show them do you look at people's portfolios and then provide advice? Okay.
So basically the whole service is built around that the algorithm constantly monitors your portfolio. Okay. And whenever the risk in your portfolio gets higher or lower than the risk limit that you wanted, it automatically rebalances the portfolio. So it's an automated quantitative investment management tool for private investors.
Okay, great, thank you.
Very welcome.
More questions? Yes, please. Get a little closer. We've comfortable seats. You don't need to stand in the corner.
I have a question. You ask questions which are relatively qualitative. I mean, they are qualitative. How do you translate it that the value at risk, which is a number?
Yeah, I mean, we ask quantitative questions as well. We have a set of qualitative questions, but also quantitative questions. We basically ask you, what is the yearly drawdown, so the yearly loss level that you feel comfortable encountering. And then you can actually set a percentage. You can set a certain percentage, starting at 3% up to 25%. That's the range where you can select your risk level. So it has a quantitative component in there as well.
More questions, things you'd like to know. Who of you works for a bank? You do. Anything more you'd like to know? What bank would that be?
I'm part of the Deutsche Bank group.
Okay.
Yeah.
And
I was just wondering, for someone who's not familiar with all that investing, I was thinking about it, whether there is a product that you can, everyone can use, not someone who has been investing for a long time.
Mm-hmm. I mean, so what I was asked to do today was basically explain the backbone of what we do. Yeah. At the very front, if you looked at our website or our app, our clients can just determine two things: how much money they want to invest and how much risk they want to take. Nothing else. Everything else is done in the background. I mean, they see it. They can have full transparency in the app or on the website, but everything is done for them. They can't select the funds we invest in. We do it for them. They can't tell us, I want now I want to go into equity, now I want into bonds. That's all algorithmic. Yeah, everything is done for them. So it is actually the product, even though in the background, what goes on in the background is quite complicated, and it took us a long time and 30 people to build that technology. The usage is very intuitive and easy.
Now, what I wonder is, you're not the first one to use a computer. You're not the first one who had the idea that algorithms understand the market better than people. This has been around for 30 years. Actually, a reason for the crash in 1987 was that at the time it was relatively new, that everyone had a computer controlling the money and all the computers decided sell. So why should I believe that you come up with an algorithm or a system that the 400 banks we have in Frankfurt didn't yet come up with?
A very good question. So all what I said today, nothing of this is new. Yeah? You have the investment methodology. Banks are using this. Big, as I said, big investors, big asset managers, sovereign wealth funds, they're all using it. And what is new is basically the combination of all of that. Private investors didn't have access. And what you've mentioned that, why are the banks not doing it? The banks could do that. That they're simply not offering it to their customer base. And not because they can't, but they have, they are differently incentivized. When you as a retail customer go into a bank branch, their goal is not to give you the best and cheapest and most efficient and most risk-controlled product available. It's simply to make money of you. Give you a product that makes you partially happy, yeah, so that you would come again, but it's, I always like to say that when you talk about bank advice, there is no advice. It's always a sales talk. You're always in a sales situation. You're always being sold something. And so doing this bank independently with the technology that the banks use, that's the new thing. It's more the combination. The innovation is not so much in the single parts of what we do. It's mainly in how we put it together.
Okay. More questions. How long is your fund out there? How long is your system
so the company
investing people's money?
The company is quite new. So we founded the company in 2014. Then we built we hired people. We are now 32 people in London and Munich. We built the technology for a bit over a year. Then we had to get a license from the BaFin and in Great Britain from the FCA. And we started managing people's money at the end of last year. So very, very fresh, very new. But we already had a very good test. Yeah, markets have been a disaster, at least for the first 2 months of the year, and it worked tremendously well.
So is your system more about winning as much as you can, or more about limiting the risk and losing as little as you can?
Exactly, the latter. Our system is not as winning as much as you can. If you want to do that, go and bet on horses. Our system is for long-term wealth creation, and the goal is start making money by stop losing money. So when markets are uptrending, we don't. It's
you
very,
don't
very
beat the
hard.
market when it goes up.
You don't. It's very hard to outperform it. There, the little changes in jumping from one stock to another doesn't make sense. You just want to participate, and that's why we use index fund and ETFs to do that. But when the market crashes, you can never foresee this perfectly. But when it crashes, you want to at least partially protect your portfolio as much as you can. And if you manage to do that, be there when it goes up, but when it goes down, not partake to the full amount, to the full extent, you get better returns for the risks in your portfolio.
Great. Thank you very much, Erik. It's been very exciting for me, a Frankfurt kid surrounded by banks, someone who challenges all the banks and put them out of business. That's a challenge.